Okay, so hello everyone. So it's an immense pleasure to be here. I was looking forward to this workshop for a while, so thank you Hyping for inviting me as well. So I am Nataliya Tkachenko. I am currently leading generative AI ethics and assurance at the Lloyds Banking Group. So we have a new generative AI Center of Excellence, which was established very recently on this wave of Gen AI craze, which emerged after ChatGPT was launched in October 2022. So all the ones got really, really excited in finance in general, because obviously finance is thriving on big text data. So we are a very interesting team as well. So I am working in AI and data ethics team, which sits directly in the Chief Data and AI office. So which means we are quite a few of us having PhDs already, postdocs, and we are very keen to see what we can do with the algorithms within finance, either repurposing already existing open source, closed source models, or developing our own, because we have loads of data in banks. So the work I would like to present today is basically something we kicked off very recently as a part of our Gen AI Center of Excellence experimentation. So we have quite a few high-profile collaborators, obviously. So we're working with the North American universities. We work with Harvard Business School. We work with Stanford University Center for Research of Foundation Models, because they're working on this new benchmark, extensive benchmark for evaluation of foundation models, specifically in language, but also image to language as well. So we're working obviously with NVIDIA, how we can do without NVIDIA in the age of Gen AI, of course, and have their interesting foundation models, not just for text, but also for images. And they have this kind of planetary computers, very similar to the ones which Microsoft had, because they actually closed that program. And we're also working with them on how we can make those foundation models much more energy efficient, because obviously we know that banks, they are very keen on reducing their carbon footprints, helping to restore the nature. Hence, we want to make sure that we're doing this with the right kind of tools, ethical tools. And ethical tools, not just socially ethical, but also environmentally ethical as well. So obviously we're working with Alan Turing, so my heart belongs to that institution a lot, because I've been associated with several centers there since 2015 when I was doing my PhD. So Maria, I think she's representing NLP team, which is absolutely fantastic, and my supervisor, Rob Proctor, Professor Rob Proctor, social informatics, he leads the team. For the last 5 years, I was associated with finance and economics group, which is led by Professor Lukasz Pruch. He's a professor of mathematics at the University of Edinburgh, and they launched this absolutely exciting program which is called FAIR, so this evaluation of the data and algorithms according to various ethical parameters in finance specifically. And obviously Google, usual suspects, Google, Microsoft, and IBM, they are also very keen to collaborate with us. I will not tell why, because we are a corporate space. So first of all, I would like to say, well, why is AI important in banking and finance? I thought I'm going to keep this presentation quite high level with kind of a fair amount of technical details as well. So obviously very important for banking and finance. So for multiple reasons, and primarily because finance has a lot of accumulated data of their own, which they're extremely unwilling to share with anyone. Hence, I think they're developing this specialist AI offices, and they also very keen to develop their own foundation models based specifically and purposed specifically for their own client base. So what are they doing with, and why it's important for the banks to have LLMs? They obviously, as you know, the advanced contextual understanding. So context is everything, and I think multimodality adds a lot more value to the understanding of various tasks here. So obviously, this is the reason why LLMs, not just specifically text-to-text, but also translational LLMs, which can be translated from text to images, from images to text, images to various modalities, and now increasingly also more exotic modalities, which include acoustics as well, specifically designed for the programs like nature finance, biodiversity restoration and recovery. So transfer learning, I think obviously these models, they are foundational models, they're trained on masses of data, and then we can sometimes, if you want them specifically designed for a particular task, we just fine-tune them, prompt engineer them or whatever, path them, and they kind of do what we want them to do. So So it's kind of very flexible tools for, and increasingly understandable tools also for non-specialists as well, not just restricted to computer scientists. Obviously, you can scale as well. So finance really like real-time analysis, and we know that increasingly large language models, they can ingest real-time data from various sources and obviously provide results and insights. And multimodality, as I mentioned already, so increasingly is of interest to the banks as well. What they call there's a traditional data in banking, and kind of text data, numbers data, etc., and a lot of it. But also, as I said, we are very keen to work with more and more increasingly with what we call alternative data, which can include social media, user-generated content, etc. All of those are driven specifically by climate finance and nature finance. So, so I mean, the kind of standard tasks here. So what I wanted to mention is that there's kind of more traditional tasks which we've been looking at, and they are understanding the meanings across a large corpus of the documents, which has been accumulated actually within banks, but also across kind of industry between banks and also between banks and regulators, and making sense of those. Sentiment analysis is kind of traditional. It's been there forever, and even kind of in the earliest possible versions of sentiment algorithms of various quality has been already ingested by various platforms in banks, and we're kind of looking into them, revising them, and upgrading them as well. So specifically, and time series. So LLMs, the use of LLMs in time series is quite limited. I think partially because there's the kind of skepticism remained that this is a limited type of application still, and they're not quite sure, due to hallucinatory properties of the LLMs, how much we can use them for time series and market moves predictions. So the models themselves, so by the way, this work which I've been showing the graphs, this derives from my research from the University of Oxford at the times of my association at Oxford Mann Institute of Financial Mathematics. I think paper is still being under revision. So we are, and obviously we're using this work and repurposing this work specifically for the customer banks like Lloyds as well. So the more the models emerged, I think we know it all happened and all kind of exploded with ChatGPT, but we all know that it all happened with Attention is All You Need, with Transformer Models 2017. It's a remarkable paper by Google Brain. So and we know that the large language models, small large language models, bigger and bigger, they emerge pretty much in kind of a very mind-blowing regularity. So what we want to know in this specific work stream is understand which of them are of specific value to finance. Because finance essentially wants to do what? They want to get the best, the cheapest possible models, which are the least risk-free and offer the maximum benefits to the customers. So here is the inventory of large language models by various providers. So this is a mix of closed-sourced and open-sourced models. Some of them will be available on Hugging Face. Some of them we are getting access to via our collaborators such as Google, IBM, and Microsoft. So I think I just quickly want to run through the series of this models. So GPT series is probably one of the most known ones. So GPT general purpose technology, actually it's a generated transformer models, architectures, and OpenAI kind of made it available and open to understandable to the world very recently via ChatGPT. But for the finance, we also have several kind of fine-tuned versions of GPT family models, specifically Plutus GPT, Plutus Gen, and they are very good at ingesting various multimodal data properties as well, and specifically well designed for tasks such as transition finance and just transition evaluations. So they also work quite well with historical stocks data and expert analysis as well. So that's what we found out in this review. So BERT family of the models. Obviously BERT is kind of very close to my heart. I've been working with BERT forever, pretty much ever since its emergence. So, and they kind of regarded that this model has revolutionized NLP, and then financial kind of spin-offs from this model were such as FinBERT family, including FinBERT 19, 20, and 21. So they introduced also as well mixed domain pre-training strategies, and they started ingesting kind of financial data, which is freely available, and also from various social media platforms. But important ones being Financial Web, Yahoo Finance, and Reddit Finance Q&As. So I'm moving to the T5 family. So there's a Google family of models. They're text-to-text transformers. They're very good, kind of quite controllable, and they are encoder and decoder types of models. I just want to quickly to mention that this interesting model we discovered is the Big Bang transformer from specifically developed for Chinese financial sector. It's absolutely fantastic and fun model, which I unfortunately didn't have a chance to work with. Then Electras and Flunk. I think Bloom is an interesting model because I think personally I've heard about the first specialized model for finance. First specialized model for finance was a Bloomberg GPT. Bloomberg obviously has a huge amount of data. They have a lot of news data. That data has never been shared for free, obviously, with anyone. But they pre-trained a very fantastic model on top of Bloom. And I think they also give ideas to many financial institutions and banks to do exactly the same. Specifically, Lloyds was very toying with the idea for using their own recordings data to develop data for our own consumption and also for investing purposes as well. And the Llama series, I think, are quite Llama models. They're fun, they're open source, and they also are kind of outperforming already smaller llamas. They could outperform GPT types of models, and Llama version for Chinese financial sector is called Cornucopia. If you haven't checked it, please check it out. So I think I'm probably going to stop here. What other models there? There are quite a few of them, and they keep emerging. I think they would just to summarize, they're doing better and better at three essential tasks for us. They are doing better Q&As, which are powering majority of the chatbots and customer-facing applications. They're also doing really, really great knowledge bases and powering knowledge bases for co-pilots and designed co-pilots which don't hallucinate for our own colleagues and help works in the everyday mundane tasks for us when we were processing financial data, and they do much better financial type of sentiment analysis for the market. So obviously benchmarks, we cannot do without those. So as you can see here, just to confirm my previous slide, is that the space is predominantly dominated by English and Chinese computer science communities. There's some decent benchmark has already been published in Europe as well. So we are planning to submit our own benchmark for customer banking during the next year as well. So I think this is a really excellent resources. I just wanted to highlight your attention and bring your attention to this main types of benchmark, which is the financial phrase bank, which consists of phrases annotated with sentiment labels. It's a pretty cool resource. Then also financial question answering and opinion mining is a FICA. And also FIQAs, which also helps even work with numerical reasoning over financial data, which is not many data sets can help with. So the question is also why we're doing this. Specifically, why good AI specifically is so important for banking? We are not tech, we are finance. So we're working with customers, we're essentially lending people money. Why AI is becoming so increasingly important for us? And why it has to be good? So partially because customers are becoming fussier and fussier. So one of these IBM's Institute for Business Value, they did this very fun research over the last couple of years, I think. I don't remember the date, but they say that about 73% of the US customers choose customer experience is absolutely crucial and important factor in choosing a bank. And we are living now in realities where there's not only incumbent banks, there's a lot more neobanks emerging, digital banks, and they increasing, and they're really, really good competitors, so very serious competitors for us. So what we want to do, we want to actually keep up. And even though we're not fintech, we still need to learn a lot more from potentially smaller brothers of ours. So unsatisfied, the fussiness of customers is also confirmed by the number 21%, that unsatisfied customers, they part ways with brand. They don't want to wait until we will become better. They will not come back and say, because I have some dedication to Lloyds, I have emotional attachment to Lloyds, I'm going to always stay with Lloyds. No, if they don't happy with something, they switch the bank, and they have plenty of choice to go for. And finally, so 99%, this is actually for North American banks, but British, I would imagine statistics well, pretty much the same for UK banks as well. And 99% of companies, they're already using AI-based virtual agents. So personally, in the UK, specifically in the UK, I think because being very risk-averse industry as compared to our North American brothers, they haven't been deployed as much. However, in Bank of America, customer-facing generative AI agent has already been deployed as early as 2018. I think it's called either Clara or Claire, but they've been so risk-taking already that at the time, I don't know, 5 years ago, they already had this type of resource. So I think being risk-averse doesn't necessarily serve you much, I don't know the word, doesn't help you much in this current environment, because environment is quite aggressive and finance is fighting for customers and for resources to invest into. So hence the AI importance. But there's some other things, other factors as well. Something like a responsibility. So being one of the big 4 lenders in the UK, primary lenders, I think on us it depends to keep the economy going, essentially. So, and economic resilience at utmost. So, Lloyds is a British bank, at the same time is a global bank, because we are investing into global assets. We are investing into various industries. So, and how we choose to invest into those industries and which ones has to be invested into, it kind of depends on us. We are kind of local global bank. So, economic resilience is also one of our responsibilities. So, we simply don't have moral right to do things wrong. And we live in polycrisis times. Polycrisis times is a systemic risk of nature degradation. You probably noticed, or maybe not. The most recent report was published by Green Finance Institute, literally probably 2 months ago, by the University of Oxford, my ex-colleague and Dr. Nicola Ranger. They published and found out that UK economic sector dependent on nature, 12%. So 12% of the UK's annual GDP is dependent on nature. So if we keep investing in something which is not nature friendly or nature degrading, we're simply going to penalize ourselves financially as well. So we need to take this into account and kind of keep up with the understanding and approaching climate crisis as well. So to update, so yes, we've been using AI in finance, simpler AI, machine learning, whatever, but it's been around for a while, and finance has been investing to different degree into it, primarily through consulting routes, but now kind of internally as well. So now we're also looking, in addition to the simpler tasks, we're also looking at added value tasks, so for example, such as advanced reasoning and also agentic type of reasoning. So this route is one of the most promising areas of research, and obviously we kind of also keeping an eye on how this research can be developed further using our own data. So those type of new types of financial services, they include kind of planning, also individualized, personalized finance, microfinance, micro lending, also recommendation system, extremely recommendation systems for investments as well, because younger and younger people, they less and less believe in the kind of saving money, we're going for the pension kind of options. They want to invest. So investment, younger and younger people keep investing, so hence they want to get the best information available and possible for themselves. Obviously, support decision systems, yeah, they want to be sure that whatever they kind of using as a tool is actually trustworthy, understandable, and not full of financial jargon. So essentially, part of financial education as well. And obviously, it has to be real time, because we live in real time. So, and in terms of that, so develop those tools and enable those tools within the banking sector. We also need to understand what kind of data exists out there which we can use and ingest. And those complexities, they do increase. So obviously, we're now using various modalities for biometrics, just to kind of reduce levels of fraud, for ID verifications, but it also has to be kind of done in a super ethical way and not reused for malicious purposes. Parametric insurance is a massive kind of passion of mine, because I've been working in space of natural disasters, floods, and all kinds of natural phenomena as well, and nature restoration. I think understanding how we can land and enable these businesses which are nature friendly is very important, and it's not enough just to work with disclosures or satellite imageries alone. We have to combine multiple modalities and smart robots of all kinds to be sure that we capture the right type of context, so we don't penalize people for who are doing good, but at the same time notice who's doing bad for various activities within the economy. Obviously, greenwashing claims are growing, they're on the rise, and they keep growing as well, because the technology is becoming much more sophisticated. So we know that we can, for example, we can modify even parts of satellite imagery as well. Just kind of currently work ongoing in my team on how we can ensure that these algorithms which can detect satellite images which have been modified. So, greenwashing technology is becoming much more and more sophisticated, so we need to account for that to make sure that we can trace those. Not always possible, because they become much more better and better. And obviously energy efficient lending. Lloyds Bank is a major lender to two big sectors, mortgages and agriculture. Two big sectors which are responsible for emissions. So obviously we want to do things right, so we want to make sure that we are lending customers which are much more energy efficient, they're doing something to their houses, retrofitting their houses, etc. But also at the same time we want to make sure that models and algorithms and data is actually trustworthy enough for us to make the decision, because we're dealing with customers and it's extremely sensitive space to work in. So in terms of multimodality, how finance recognizes this growth and hunger for multiple data sources? Very well, actually. So unfortunately I lost the source, but I will dig it out, I promise. So financial value of multimodality is going to kind of spiral upwards, because they say that compound annual growth rate of multimodal AI market is expected to be worth like 4.5 billion by 2028. At the moment it's 1 billion, last year it was 0.9. So we can see that it's not just we will be ingesting more and more modalities. Essentially all the startups which will be using multimodal data will be absolutely interesting type of investable agents for us. We will be investing and funding those startups as well, the ones which will be doing a multimodal analytics right. So now I actually want to switch a little bit to the topic of safe AI, something which I'm working on. So I wanted to mention, I probably haven't at the beginning, that every time the model emerges, people get excited about what I can do with this model. My first kind of instinct is that how I can break this model. So my instinct is understandable how resilient and robust this model, because this robustness essentially defines how good this model is and fit for purpose will be within my organization. So what can define is the model safe or not? So I don't know how much you follow the regulation of AI and what's happening in regulatory space. You probably know that we've been hosting in Bletchley Park AI Summit, and a lot of high-profile politicians been there. I think Elon Musk was there as well. Obviously, not without him. But I think essentially what UK have decided to do, they decided to be pro-innovative. So they have this regulation-free, pro-innovative approach. So we experiment, let thousands of flowers bloom, and then once we identify in this process of some risks, then we will start reacting and thinking potentially into the direction of much more kind of universal AI regulation of the type, I don't know, EU AI Act, which is the first in the world type of regulation. It doesn't mean that we are completely regulation free, of course not. So we have finance, we have healthcare, they have their own type of model scrutinization type of work. They have model risk management systems, and they're extremely kind of, I would say watertight in this respect. Sometimes we even call them over-regulated. But they have their model risk management, and they allow to kind of keep this area under control. So the only kind of disadvantage of those existing regulatory bases is that they're not necessarily well designed and very well adapted to generative AI. So as a consequence, in Lloyds we are scanning the entire global landscape of emerging regulations And specifically, we're also collaborating with NIST. NIST is the National Institute of Standards for Technology in the United States, and they have very interesting guidances for implementation of artificial intelligence-based type of tools within organizations, including finance. They're pretty cross-sectoral. They have a lot of interesting workbooks to work with, but they are specifically designed. They're complex, sometimes difficult to understand. They're kind of lengthy, but at least we have this material to build upon and adapt specifically for our organization. What they've done as well, which is great, 2 months ago, I think it was on the 24th of April, I might be wrong, but in April definitely, they published the addendum to the already existing AI management framework, risk management framework, specifically covering generative AI as well. So to this type of document, they attached also possible type of mitigants and guardrails, which cover such risks as confabulation, so hallucination essentially. I don't know why they created this new word. Sounds fancy, I like it, but yes, it's essentially hallucination. Toxicity, data privacy, alignment, information integrity, security and property, and obviously value chain. So what does all these risks mean and how we can trace them? So it's really up to us how we trace them. So we need to identify a number and sets of metrics to cover all those risks. So, I think it's a good start for us. The only thing which they didn't really cover well was this environmental footprint, and this is something we're already doing in the as part of our FAIR program in the Alan Turing Institute. So we published this paper in collaboration with HSBC and FCA. In March, we had the launch in the Royal Society in London. So we basically, so this is, I extracted my own paragraph from the report, where I'm basically saying, well, we absolutely need to talk about the footprint as well. We need to include footprint, carbon footprint, energy consumption of large language models. And we need to treat them no different than we treat other sectors, specifically when we're talking about scope 1, 2, 3. Why we want to do the same for AI as well. So when we are developing our own model or we're sourcing the model, we need to make sure what kind of resources, how much of those resources those models consumed, because those resources becoming less and less non-negligible. So why do we, so what ethics has to do essentially to do with it? Ethics covers, so ethics are very often being associated with something kind of very philosophical, good or bad. Should we do it or should we not? If we don't, it's not a big deal. But however, it's quite super important and we're taking it very, very seriously. So specifically in finance, because what ethics does, it covers the gray area which regulation currently doesn't, but it will or it must, because it will create such repercussions that will become extremely kind of damaging, reputationally damaging for organizations like finance, etc. So they should be done right. So ethics actually serves a very extremely important purpose, and it's very, very far from being soft science. The ethics we're doing at Lloyds, specifically, it's a computational ethics. So we need to develop our own algorithms, which are almost adversarial financial algorithms, which should render existing model bases safer for our purposes, consumption, and for our customers. So the decisions, basically, it's when we decide on the model, when we pick the model, say, okay, it's 90, 95, 97, 99% accuracy. This is great. We judge model on that kind of parameters. However, for us, we don't think like that as ethicists. We are interested in that 1-2% when model fails. And that 1 or 2% can be catastrophic enough for us to make us appear across all the newspapers and for us kind of to lose our value almost overnight. So if you pick wrong data set, like there's quite a few different, I'm just taking here an example from satellite imagery, Moody's, how they call it, vegetation indices, normalized different vegetation indices. So if you, for example, you want to lend to agricultural producer, farmer, or we want to insure them, we want to find out what kind of activity is happening. But however, different satellite data have different resolutions, different temporal resolution as well, and different channels, spectral channels. If you pick a wrong data set, and if you put it in the wrong algorithm, which has kind of a different type of errors levels, then obviously we will have a different outcome, and we either increase premium or coverage, exclude a certain vulnerable part of our customer base. It's extremely important for us. For us, understanding, so numbers of the model's performance, statistical ones, doesn't necessarily tick the box. It has to be done and evaluated properly, ethically, according to the downstream negative consequences. And so what kind of model-driven risks exist out there? They can emerge out of pretty different from different places. For example, they could be false positives and anomaly detections, where they're trying to understand whether those oil leaks been identified correctly or not. Also, whether we are identifying, for example, I've been working a lot on mining, deforestation patterns and attribution according to the mining activities of big corporates. So if you kind of miscalculate that, we kind of create a negative publicity for the company who essentially potentially did nothing wrong legally. And then just statistical modeling. So of course, lots of them, because new emerging data sources, they are interesting for the banks, and they don't understand the data as well. So for them, if somebody turns up a satellite image and say, okay, great, now we can do something right, but not always, because you have to do you have to pick exactly right product, and that product has to be tested and stress tested across multiple geospatial algorithms, because metrics exist there and they differ, and sometimes they don't even converge properly. And obviously fusion. So because we're talking about multimodal space, data fusions can also provide some results and some potential errors which can become quite problematic for us. So I wanted to mention that how we design the metrics. So for example, we need to have a complete and coherent and also quite standardized kind of set of metrics which we can scale across multiple models. And I think this is where kind of a problem emerged till we started talking to Helm people. So it's a holistic evaluation framework for large language models, and they already done some of the effort for us. They basically analyzed multiplicity of multiple models, large language models. They've been analyzed, and always they reported with different types of metrics. What they've done, I don't know exact number of models they've done. Please check out their paper. It's a very kind of well-known framework. What they haven't done, though, they haven't adopted the set of metrics specifically for finance. I think on their website it still tells forthcoming, but nevertheless, I'm sure even they will publish it for finance, it will be for generic finance, and not specifically designed for a particular financial institution. So we didn't decide if we're not going to wait, we're going to develop our own kind of standard base of indicators which will help us to evaluate models and tell to our leadership, okay, this is the right model, this is the wrong model, and this is how we evaluated it. So what we've done essentially, we are compared the semantic tasks. So we done a sequence of interviews across the bank, across different BUs, so business units, so which are working with mortgages, with motor finance, kind of all kinds of insurance and lending, credit cards, and we identified what kind of semantic task is of interest to them and how large language models can help them do their work better. And could be internal work, colleague-facing, but also equally could be for customer-facing or enabling customer, knowing customer better, etc. And then basically what we've done, we translated those metrics such as toxicity detection, sentiment analysis, something which I already mentioned at the beginning of my presentation. And here I'm just highlighted example, by the way, for our first kind of focus area, which is the title of my presentation: parametric insurance and conversational banking. And then we translated this into identified metrics, which has been published on the Helm website. So the main categories here, specifically, I think it's a monomodal type of monomodal type of models, and they're text-to-text models essentially. So, and the key indicators we identified, they cover robustness, fairness, accuracy, calibration, bias, toxicity, and also runtime CO2. So they have a little bit of a kind of energy efficiency type of indicators, but not good enough for us, and I will explain it later why. So now we're moving, okay, so we're working in text-to-text banking, we're making text models safer for ourselves, but at the same time we want to know, well, we need to look forward, and what happens if we also, what kind of task would be of interest to multisensory banks. So, for example, we have chatbots, but we potentially will want to have chatbots which are interactive, which have some kind of avatars, and quite, can predict something as well. So because and act almost as personal advisors. So we also identified through the sets of interviews what kind of tasks they potentially would want to have in the future, and those kind of include much more complex, much more synergistic type of tasks. They They'll be moving away from sentiment analysis, from named entity recognition, etc. They're quite granular semantic tasks. I think what going to be in the future that we'll be aggregating them into AI-powered driven financial services. And those would include financial analysis and reporting, assessments, but also with element of education, because finance is extremely jargon-rich type of industry. And as I said, not everyone has a financial education. Sometimes people don't understand. The policies are written in such a way that people don't understand where to start, where and what to do, and even let alone not even going into investing, which is becoming increasingly exciting area for people of multiple of a range of ages. And also policy details and claims process. So it has to be done in a certain way, and we have now a formal requirement from Financial Conduct Authority to diversify our approach towards our customers. So we have different categories of vulnerable customers, and we want to make sure that we personalize our approach so we don't discriminate anyone, and we treat customers fairly. Because we're doing that, why? We want to retain our customers, not only retain them, but also increase our customer base as a bank which treats customers perfectly well. So then, multisensory banking, that's just a task. So we also want to know, if we want to develop this type of capacity, what kind of risk indicators of those new emerging types of services will be of importance? Are they different? Are they the same if in text-to-text models, or they will be slightly different ones? So we identified 2 additional levels, which is the reasoning and efficiency. So we want that those multimodal agents to be able to interact almost like human to human, not like a machine to a human, and also to be quite efficient. Don't wait for 3 hours before your avatar responds to you or to your query, like at olden good times when we had a massive dropout of clients using all the technology within chatbots. So, and obviously risk metrics is much more broader, which is not surprising. And in this instance, we also identified in the literature there was additional types of metrics for us to consider, and those metrics include obviously statics, alignment, and originality. So alignment is something which is already we've seen in the realm of text-to-text models. So, if, for example, we want to make sure that our chatbots, our advisors, they're not talking about other banks or use a different tone of voice or not polite to our customers. We want to make sure they align properly. But this type of alignment is actually multimodal alignment. 2 minutes left, and that we actually what we see, what we hear is actually coherent. That's kind of the easiest way to explain it. So, and obviously me being an ESG geek, why? What about CO2? So, in AI deployments, not just in training, but also when we deploy AI services, how energy, inefficient they can be. So obviously this identifying. So this work is not mine at all. It's the work we're building currently upon. This is from the Hugging Face Climate Unit. So they're currently building something really cool, which they call researching star ratings for foundational models. So Sasha Lucioni, she's a scientist there. She's also one of the co-founders of Climate Change AI initiative, which I was part of when I was doing my postdoc in Oxford. So they're working on how and evaluating, can we actually achieve the same task and the quality and the performance of the same task using different types of architectures. So, and those kind of major tasks they looked at, they are classifiers, so kind of highly supervised tasks, then extractive tasks, kind of semi-generative, and then highly generative, abstractive, intensive tasks. So they actually found out that interesting thing that obviously is not surprising, that abstractive tasks, generative tasks, they're always going to be much more energy hungry, energy highly consuming energy, and emissive. But the interesting thing about it is that they found out that, although I don't think it's a complete study, I think we need to rerun it multiple times, is that peak performance demonstrated that generative task peaks at 7 billion parameters. So essentially, we can reach a certain level of quality at particular levels. So we shouldn't keep building bigger and bigger model, because it will not always equate to higher and higher quality. However, it will always equate to the higher levels of emissions. Then obviously model accuracy across classification and question answering. So what they found out here, which is kind of fun as well, is that sometimes, if you look at the beginning, sometimes you can actually reach the same level of quality of classification Of course, it's a highly supervised task anyway, but nevertheless, you can reach it if it's a very simple encoder model, which kind of not energy specifically energy hungry or energy, aggressive. However, kind of obviously downside here is that it's not going to be multitask. It's going to be very narrowly defined classifier. But still, if you are bank and my time is up, then you still have to consider this, because if you have a narrow task, you don't necessarily need a massive transformer for that. And mixed modalities inference. Well, basically we know that imagery kind of, when you mix modalities, that they will be the energy use is going to be increasing, but it's not as simple as that. And there are some interesting findings we're finding at the moment. But my time is up. I will not be able to tell you that, but I will keep you excited for my next talk somewhere. Just to conclude and to say, so obviously multimodality is going to be growing in financial AI, and it's because for multiple reasons. But also it represents a set of new risks which are not necessarily linearly proportional to the tasks. So we need to take this into account. Visual modalities usually the biggest energy consumers and emitters, not surprising. And currently metrics is under development, and this metrics needs to be, I think, uniform, because we are kind of very standardized in a highly regulated space. So we want to make sure that when we're communicating about our findings, we want to make sure that others understand what we are talking about. And I'm very grateful for your attention, and apologies for running over the time.
Thank you, Nataliya.